Okay, well, we're just a couple seconds early, so that's good enough to get started. So, hello, everyone. Welcome to this month's webinar. For those of you who don't know me, I'm Kristina Kuprina, and I'm the Chief Portfolio Manager and Economist at Sequoia Wealth Advisors. And we have our special guest here today that I'll introduce in just a moment. At first, I wanted to thank you very much. We got a lot of registrants, but a lot of people saying they can't attend in person. So we have a ton of questions that were sent in advance. So thank you so much for doing that. So those of you who are listening in later, you'll get your questions answered this way. So I really appreciate you sending them in advance. So again, for all of you who don't know me, we do these webinars about once a month, kind of a little bit of update on the economy, make it fun, make it interesting, have your questions answered. With the highest intention of making all of this information relevant to you in your lives. And as many of you know who've been attending these for years, we also bring in special guests because you don't want to just hear Kristina's view on the world. Okay, maybe some of you do, but there's also other views in the world, and there's some really, really good people out there that we work with at Sequoia, and we love to have them come in and talk a little bit about what they're seeing and what they're doing, especially those that we work with. So today's guest is Joanne Feeney, and she is from ACM Advisors Capital Management. I'm going to read her bio real quick, and then I'm going to share the connection here. And I want to say, if you have any questions for her as she's talking, just send them over on the questions on the Q&A. And when she does, she'll take a break, and I'll make sure to get them out to her and get all these questions answered here live. So Joanne Feeney, I will read her bio. She's a partner, portfolio manager, and member of the investment committee with Advisors Capital Management. Prior to joining ACM, Dr. Feeney was a senior equity analyst for more than 10 years at boutique sell-side firms, including Punk, Ziegel & Co., FTN, Equity Capital Longbow Research, and ABR Investment Strategy, where she focuses on the valuation, or she focuses on the value of semiconductor companies. Dr. Feeney is also consulted for the Federal Reserve, a consultant for the Federal Reserve, the International Monetary Fund, the World Bank, while an academic at the University of Albany, State University of New York, the Stern School of Business, New York University, and the University of Colorado in Boulder. Dr. Feeney appears often on Bloomberg, CNBC, and frequently quoted in Barron's and the Wall Street Journal. I'll stop there. You know, all your education backgrounds is very impressive, and just say that Dr. Feeney and I met one another years ago at an economic conference. And while I can probably, no surprise to anyone, female portfolio managers are few and far between. But what really captured my attention with, like I say, Dr. Feeney, or I can say Joanne.
Joanne is fine.
Joanne, okay, with Joanne was that she has an amazing ability to combine her extraordinary academic knowledge and experience with an understanding of futuristic trends, to see beyond the numbers today and see what's possible in the future, and pulling that together. Many of you clients, you are working with ACM directly, and she's involved in your portfolio management. So it's not just Kristina. We have other really good and highly qualified people that are involved. So again, today is an opportunity to hear from Joanne, a little bit about the economy, what she's seeing, kind of a bit about the process, and answer all of your questions today. And if time permits afterwards, I'll hop in and answer a few of the questions you guys sent over to me. With that being said, I'm going to go off camera. I'm going to be here listening in the background just to give the full screen to Joanne. But again, send those questions in. So with that being said, take it away.
Okay, thanks, Kristina. Good to be here with you guys and your clients. Hello, everybody. So Kristina asked me to step in and talk to you about the investing environment and our view on opportunities for investors. So as you may be aware, we offer several different types of portfolio strategies for you folks through Kristina. Now, the one set of strategies I manage includes our balanced strategies, and there we offer the 3% yielding strategy, 4% yield, or 5% yield. I also co-manage our growth strategy, but the firm offers several other choices like international or small and mid cap, income with growth, and that sort of thing. So there's a range of opportunities, and so therefore our view on the investment environment is often going to be sensitive to the strategy goals in particular, and each of those strategies has different goals. So I'm going to talk a little bit about what we see out there in the investing environment. Obviously, that's going to include our view on the U.S. economy, the global economy, the political situation, and some of the changes and volatility that we're seeing now. So I'm going to share my screen and just go through some slides, which I'll just use as sort of examples of the sort of information that is relevant to all investors. So hold on one second. Let me just share this. Okay. Okay, so can you guys see my screen, Kristina?
Yes.
Okay, perfect. Okay, so it's always important to look at the big picture. One thing that has helped improve the investing environment, that has helped the stock market over the last few years, is this decline that you're seeing in this graph of inflation. Not just for consumers, but also producers are affected by higher cost of input. So been a pretty dramatic decline since that peak in 22. That was a consequence of COVID and a lot of the stimulus payments that were made. But the Fed has done a terrific job of bringing that down over the last couple of years, and it still is ticking lower. So that's all good news. The Fed, by the way, is meeting this week, and they'll have a press conference tomorrow talking about what they see. And I'll talk a little bit about some of the sort of forces at work that underlie the Fed's situation right now. Another thing that plays into our picture of the investing environment is the overall health of the job market. How many people have jobs? What is the unemployment rate looking like? And as you can see from that graph, which goes all the way back to 1990, unemployment rates in the US are at pretty low levels, near historic lows. And, folks that are looking for jobs, many of them can find jobs. This is not to say that there aren't still, though, a lot of unemployed people, a lot of people that left the workforce during and after COVID that have chosen not to come back into the workforce. It's important to understand that the unemployment rate only measures the folks unemployed who are looking for work. So if people have left the workforce, they simply disappear from this data. So it's an imperfect measure, but it clearly gives us a sense, at least, that the situation in the U.S. labor market is pretty healthy right now. We're also seeing that in the monthly job creation figures. These are net job additions. And while they have come down over time since 2022, they're still running fairly positive. And if we look at the job openings that are available for those seeking work, they're clearly lower than they used to be. And I think right now they're running at a bit over one and a half jobs per person out there looking. So the labor market is tightening up relative to what we saw a couple of years ago, but there are still job openings out there. And moreover, what we're seeing in terms of earnings for employees is this is a graph that's showing you growth year over year in hourly earnings. And that chart is showing you that hourly earnings are still growing at nearly 4%. So that's keeping ahead of inflation, right? Inflation is now sort of 2.5%-ish. And that means that the real spending power, the amount of goods, products that folks can fit in their shopping cart at the grocery store or at Walmart or Target, that quantity of goods is growing over time. In terms of adjusted for inflation, folks are making more. And in addition to hourly earnings, that rate of pay, there are more people employed, and especially if we look back over the last few years. And that's largely what supported the strength of the consumer and consumer spending over time. More people employed, they're making more money, they're keeping ahead of inflation, and that's why it's been such a positive environment for investors. However, we do have to be concerned about the total supply of workers in the economy at this point, because there's been a pretty widespread crackdown on the immigrant labor force. And if you look at this chart, it shows you that the growth of the labor force in the United States over the past several years and over a decade has largely been because of foreign-born workers as opposed to native U.S. workers. And so there's a risk that reducing the number of foreigners that can work in the U.S., there's a risk that that's going to slow GDP growth. It's hard to produce more stuff if you don't have more labor to do it. But the impact on the economy will not be uniform. If you look at where foreign workers show up in the labor force, there's sort of two ends to that. One is at the very high end, very high skilled workers, highly educated engineers, a lot of them who come and get schooling here and then stay, contribute to the service economy, in particular the information services economy in many ways, and also manufacturing of high-end goods. But then there's also the lower end of the income spectrum and the work spectrum, where you're seeing a lot of immigrant labor staff, construction jobs, restaurant jobs, hotel jobs, farming, and other sort of more manual labor sort of work. So the reduction in the foreign-born workforce and in the growth of the foreign-born workforce is very likely to have a negative impact on economic growth. But it's important as investors for us to look at the areas of the economy where that's likely to be more impactful. What we do also see in the US economy is that manufacturing jobs as a percent of the total have really dropped. And this is a chart that goes all the way back to post-World War II, 1948, and when it was, 25% of the workforce, and now it's considerably less than that, somewhere around 7%. So when you look at manufacturing jobs, it's just not a big part of the US economy anymore. And so there's less of an impact on the opportunities for the worker from the manufacturing sector. We're largely now a service economy. And as you can see, once again, even in the manufacturing space, a lot of it is in farming and other hired work. Now, so when we think about GDP, we think about production. Most of it's services, some of it's manufacturing, as we just saw. We want to also, though, look when we're assessing the investing environment at the health of the household. As I just laid out, more people are employed, hourly earnings have been rising, the real value of disposable income has been rising. But on the flip side, we're seeing consumers take on more and more credit card debt. And if you read some news articles, you'll find alarm at that. Oh no, households are taking on more credit card debt. Are we on the brink of a crisis where they suddenly, can spend less because they have to service all these credit card bills that they owe? And then if you look at the student loan debt, that even potentially complicates that. More and more student loan debt, which was, the repayments were deferred for some time, and now, it's time to start repaying those. So you might look at these two slides and say, oh, well, boy, the consumer is about to become more of a headwind for the economy as opposed to a support for consumer spending. But context is really important. This is a large economy, the US. And in fact, over those years where you saw credit card debt rise, you've also seen incomes rise. The countrywide GDP has gone up. And so when you look at the debt relative to GDP, it's actually come down pretty substantially over the last couple of decades. And so that's that's context that you don't often get when you read a simple news article about the household debt situation. So in other words, households can afford this debt overall in the economy because the economy is so much bigger and so much wealthier. So don't be alarmed. Now, another big area of the US economy is the home building sector. And that has faced real challenges lately because mortgage rates have gone up. Now it's around 7-ish%. But that's not very different than it was a couple of decades ago. But we all got used to very low mortgage rates. And if you have a house and a mortgage rate now that you took out sort of pre-COVID, you're enjoying a very low mortgage rate, and you're probably reluctant to move because why give up such a wonderful loan? And so there has been a definite slowing in the housing market over the last year because of the last couple of years because of those high mortgage rates. Now, it's important to understand that, when existing homes are sold, they change from one person's ownership to another. That doesn't add to GDP, doesn't change it really in any way, except for the realtor fees that get collected. But the house was already built, so it's not adding or subtracting from GDP when it changes hands. What we really care about in terms of jobs that are created and incomes that are created is building new houses. And there's clearly been a slowdown there, and it would be very helpful if mortgage rates were lower. But it's unlikely we're going to see that anytime soon, given all the pressures on interest rates in the US economy. Here's another alarming news item that you'll see. Oh, consumer confidence is down, right? And as you can see, it's a very volatile thing. There have been certainly times in history when lower consumer confidence has been coincident with recessions. We saw that in the early 90s. We saw that in the financial crisis of 2008. And we certainly saw that back in the 80s as well. This time around, though, we saw that dip in consumer confidence in 2022, largely because inflation was so high and that worried a lot of people. But we didn't see a recession from that. It's dipped recently. It has recovered since those January numbers a little bit, but it's not really a very good forecasting tool. And in fact, I saw a research paper that looked at the causes of changes in consumer confidence, and it was almost entirely correlated with interest rates because that's what they see. They see the cost of their credit cards, they see the cost of car payments and potentially mortgages. It has less to do with future predictability than anything else. But here's obviously a big one, and we will talk about the big news this week too. But tariffs and trade have become a lightning rod for discussion among investors and among the consumer. In fact, we saw a big drive to buy cars ahead of the Trump so-called Liberation Day when he announced an imposition of very significant tariffs on multiple countries. He's since paused those, but they're still out there as a threat. And so when we look at the history of trade and tariffs in the United States, what we see, and this chart is back to 1989, we see a pretty much steady decline in the effective tariff rate. What effective tariff rate means is look at all the goods that are imported, look at the tariffs applied on those, what's basically the weighted average tariff. And as you can see, tariff rates were exceedingly low, below 1.5% before Trump's first time in office, at which time he raised them significantly. And they stayed up there for a while, since 2018. And then most recently, he announced these significant increases in these tariffs, which would have raised the effective tariffs rate by more than double what it was for many decades before he came into office in 2017. Why do we care? Because, you guys as shoppers, let's just put the shopper hat on, not the investor hat. You guys as shoppers go out and buy stuff. And, a tax of 10%, 20, 30, 40, 50, and 150% potentially is going to raise the price of the stuff you buy, whether it's on Amazon, whether it's at the grocery store, whether it's at the appliance store. And that means that, budgets are going to be constrained. And so you'll have to cut spending someplace else. You cut spending someplace else, then that potential seller doesn't need to make as much stuff. And therefore they don't need to hire as many people. And so then you start to see an increase in unemployment. So that's the concern on the consumer side. Firms also import a lot of stuff. They import various components and parts to build stuff they ultimately sell to you, whether it's a house builder that needs to import lumber or steel. That's going to raise the cost of building a house. And that's particularly problematic now when the steel tariffs have been doubled to 50%, tariffs on lumber out of Canada. All of these add to the cost of building a house. And when mortgage rates are as high as they are, that constrains the home builders. And they are trying to offer discounts to offset a lot of this, but it is causing a decline in their margins. Lennar is a company we own in the growth strategy for clients. And they had good numbers. They reported last night. They had pretty good numbers, but it's clear they're having to cut prices to help offset the high mortgage rates. And that is constraining their margin given the high input costs that they face. So tariffs not only affect the consumer in a broad way, it's like a tax, but it also affects producers because it raises the cost of their inputs. So economists, and I'm an economist by training, economists don't like tariffs generally because they're inefficient. They are a tax where they discourage consumption, they discourage investment. And so we're hoping that all of these negotiations that are currently in progress by the Trump administration will ultimately not lead to the high tariffs that were threatened back at the beginning of April, which put the stock market into a bit of a tailspin. But we have yet to see how these will play out. We're hearing of some reprieves. And so here's an example of how it can really affect actual trade, right? These are ships. These are container ships departing from China to the United States. And as you can see, there was this big spike, this big increase in shipments in March, from mid-February to March as retailers here, as auto dealers here, as consumers here, all wanted to buy stuff out of China before the liberation tariffs were announced. And then we saw a steep drop off in shipments, because they had basically, consumers and firms had front run the tariffs. So let's get ahead of them. Let's buy our stuff. Let's get it on the shelves, or at least get it in inventory. And since then, we've seen further declines in those container shipments. So it's a really stark example of how those taxes affect behavior. Now, I mentioned before that mortgage rates are high and unlikely to come down. Right? The mortgage rates you see are based on the 10-year Treasury, and the 10-year Treasury is going to be sensitive to the amount of borrowing that the federal government needs to do, as well as corporations and other entities. And we've certainly seen a big increase, as this chart shows, in total public debt. There are some that are quite concerned about these levels, and we're seeing the House and the Senate consider a new budget. And in that budget, both House and Senate have proposed an increase in the annual deficit spending level. The Senate proposal, which was out last night, pushes that increase in deficit spending to $5 trillion. And so that's a pretty big potential addition, 1 year at a time for the next several years, that would increase the total public debt. And so, we have to recognize that that's going to put pressure. It's an increase in the demand for borrowing by the federal government. Somebody has to loan the federal government that money, but hey, it's an awfully safe, relatively risk-free asset. And there's a lot of folks, both here in the US and around the world, that want to lend to the US government because it's a safe place to stash wealth. And right now it's offering a pretty decent return, about 4.5% on the 10-year, nearly 5% on the 30-year. And given where inflation is running, that's not a bad real return, an inflation-adjusted return over time. It's not nearly as good as potentially in the stock market, but as you know, stock market returns tend to be a lot riskier. So, there's a lot of debate that will be going on about the budget, but the concern is that we're going to see upward pressure on interest rates because of the growing size of the US federal debt. And the challenge for the House and the Senate is that there just simply aren't many ways to cut spending. And so if you want to keep the tax cuts that Trump 1.0 passed, and you can't really cut spending very easily because of this chart showing you that there's just very little discretionary spending. You've got the entitlement programs, Medicare, Medicaid, Social Security, you've got national defense, not a lot of room to cut there. Interest on the debt, obviously you can't change that. You've got money for the veterans, and then you've got various social programs and investment programs, whether it's education, medical research, scientific research, etc. So there's just very little room to cut. So without raising taxes, it's nearly impossible for the US to balance its budget. And we're at a period of time when the economy is pretty strong. That's generally when countries tend to run budget surpluses, when times are good. When you get to a recession, that's generally when countries run deficits because you've got to pay more on unemployment insurance and other social safety net programs. So it's a real challenge to get the budget in line when you want to keep taxes as low as they are. And that's why, our view is that long-term interest rates are unlikely to come down anytime soon. There's just too much pressure, too much demand to borrow by the federal government at this point. Okay, so there's been some efforts to tackle the deficit, but as you can see there have not been there's not been a lot of progress. And when you have a deficit in the trillions, even tariffs, which could potentially raise revenue, are orders of magnitude smaller in terms of the revenue they would generate from those taxes. So that's not going to work. And, there's an attempt to reshore manufacturing, which could, potentially add some tax revenue, more production here. But there's just very little capacity in the US to raise manufacturing very much because there's very low unemployment. And reducing immigration labor constrains further the ability to raise GDP growth and therefore raise tax revenue. So it is really a tough place that the US government is in right now in terms of trying to close the gap on the deficit. And so therefore, again, we should expect interest rates to stay high, at least longer term interest rates. And that's why we don't expect much in the way of Fed rate cuts, even at the shorter end. And that's for two reasons. Okay, when you understand what the Fed's dual mandate is, you'll understand why it's going to be so hard for the Fed to move in either direction. Okay, on the one hand, their one mandate is for stable prices, that is keeping inflation low, and their target is 2.0%, and we've been moving in that direction. So they've kept rates high in order to move inflation lower over time. The second part of the dual mandate is maximum employment. And that's why you'll hear arguments that says, hey, if the economy is slowing down, the Fed should cut interest rates to stimulate the economy, because lower rates make it cheaper to borrow, they make it cheaper for firms to invest in new plants and therefore potentially hire people. So if you're heading toward a recession, or if you're in a recession, that's typically when the Fed would cut interest rates. Now we have a situation where, with tariffs coming potentially, you have something that is inflationary. Tariffs raise prices. On the other hand, though, tariffs also reduce economic activity because they make things more expensive. Now, one could argue, hey, but tariffs are just, one-time increase. You put a tax of 10%, prices go up by 10%, you're done. That's just a one-time increase in the price level. But the problem is that it isn't always the case that that price increase happens all at once. And when a foreign product is being taxed at, say, 10%, that often leads to domestic competitors raising their prices as well. They may not do it right away. They may do it slowly over time as they see how consumer demand shifts. And then when they raise their price, that might cause somebody farther down the supply chain to say, oh no, now my thing to build is more expensive, so I have to raise my price. So it's often the case that it takes time for these price increases to propagate through the economy. So instead of a one-time price increase, you actually get inflation. And then the concern is that if people think and see prices rising, they might think they're going to continue to rise. And then you get an expectation that inflation will be higher instead of moving in the direction the Fed wants. And it's that change in inflationary expectations that could be self-fulfilling, because then labor starts to say, well, prices are rising, I need a higher wage. And so you end up with a situation where inflation could get re-embedded in the economy, which means the Fed has to keep rates higher, even move them higher than they are now. On the other hand, if tariffs make things more costly, that causes the economy to slow down. They should be cutting rates to stimulate. So the Fed is in a no-win situation. On the one hand, they need to keep rates high to offset the inflationary effects of tariffs. On the other hand, they might need to cut rates in order to stimulate an economy that is slowing down because of the tariffs. And so it's most likely that the Fed's just going to do nothing until they see which of those two forces is the more dominant one and the more important one in terms of managing long-term expectations. So we shouldn't expect much help from the Fed is the bottom line. But there is good news. And the good news is that when you look at the S&P 500 companies, we're seeing some pretty strong earnings growth. In fact, earnings dollars for the S&P 500 companies, this is a chart showing you the earnings for the group over time, annual earnings growing over the last decade. Or this chart is only for the last 4 years, but this expectation has been growing in the last couple of years. So firms are being very productive, right? They are producing more stuff. They're generating more earnings. Now, this index we know is dominated by the big companies, right? The top 10 companies in the index account for about 35 to 40% of the market capitalization of the S&P 500. So those higher earnings are capturing really what's going on at the top of the market: Apple, Microsoft, Amazon. And those companies have been doing quite well. They're producing more services and they're getting paid more for them. And so their earnings are really driving the opportunities in the index, in the market as a whole. In fact, for this year, this calendar year, 2025, it's expected that S&P 500 companies will see their earnings grow over last year by nearly 10%. With the leadership coming out of the information technology group at potentially 18% earnings growth year over year, and laggard being energy. As you've seen, oil prices have come down a lot. That makes it awfully hard for the energy sector, particularly the big conglomerates like Chevron and Exxon, to make a lot of money. So their earnings are expected to fall at one end of the spectrum, while infotech, communication services, healthcare, all expected to see double-digit increases in earnings. So that makes for a really good investing environment, even in the face of potential costs from tariffs. And then you have to ask, but is it a good time to invest? Because the market seems kind of expensive. The amount you're paying for $1 of earnings right now in 2025, and these numbers are a little bit dated. I think we're a bit higher than this. This is April 30th. It costs $20 to buy $1 worth of earnings. That's the second row, the PE ratio, price to earnings. It's the price you're paying for $1 of earnings that would be delivered over the next 12 months. The dividend yield is pretty low right now. It's only 1.7% on the S&P 500 as a group. And so there have been a lot of questions asked. Hey, is the market too expensive? And here again, it's important to not think of the market as a unit, right? The market is made up of 500 or 503 companies. And so if we look at a breakdown of those companies and look at just the top 10, the amount you're paying for $1 of earnings of the top 10 companies, Microsoft, Apple, etc., Amazon, you're paying a lot more. You're paying 26 times $1 of earnings, $26 for every $1 of earnings. But if you look at the other 490 companies, you're paying much less. You're only paying about 17.8 times. And so it is the case that there are opportunities, there are value opportunities that are still in the market. We've seen companies at 5 times earnings that are, facing some challenges. That's often why they're that cheap. But there are value opportunities for the long-term investor. It's important, if you're going to pay 26 times $1 worth of earnings, that company have a considerable amount of growth ahead of it, because that's ultimately what you're paying for. You're not paying for 1 year's worth of earnings when you spend that much, whether it's an Nvidia or an Amazon. You're paying to own that company because that company is set up to continue to grow its earnings for year after year after year. And that makes it worthwhile to spend more for that stock than potentially for a stock like General Motors, which is facing real challenges in growth and which has really high capital expenditures, which could pressure their balance sheet and pressure their earnings in the future. So picking apart the individual companies is really important. When we look just at the Magnificent Seven, what we've seen is a lot of volatility. And so while you might be tempted to just fill your portfolios with the Magnificent Seven because they've done so well in the last couple of years, it's important to look back, for example, at 2022. The S&P 500 was down 19%. That was a tough year. But the Magnificent Seven companies were down 40% on average. So most folks don't want to see that much volatility in their portfolios. And while those companies did rebound very strongly in 23 and 24, they were also down early this year by 15% through the end of April. Many of them have rebounded. So that's why, what we prefer to do for clients is build a more balanced portfolio that's more diversified. And for those that don't want to see the full amount of risk associated with equities, we build in, right, the fixed income side in a balanced strategy. And you get to pick whether it's 70-30, 60-40, 50-50, whatever mix you like in 10% increments, we can handle for you. We also like to build in income for a lot of folks, whether you want a 3% yield, gross yield of 4% or 5%, we do that by changing the mix of companies inside the strategy. So there's a lot of ways to get around the volatility of just owning the high-flying stocks. We don't advise that ever. And the way we do it is by diversifying across sectors. And you can see here how much of different cost it is to do that. The cost, the price you're paying for $1 worth of earnings in communication services might be 17.5 times, but in energy only 14 times. So there's a lot of opportunity to find value sector by sector, and then within each sector also to find value. So as you're aware, at Advisors Capital, we tend to have a value bent. Obviously, there's exceptions for that. The growth strategy is more of a growth at a reasonable price strategy. Small and mid cap tends to be more growth oriented, but we do like to find the companies that offer a value and solid balance sheets and strong cash flow to support the dividends that we try to build into many of our strategies. Okay, well, before we get to questions, let me just make a quick comment about the current political situation. And now, we're not political experts, but we have a lot of folks on the investment committee that have a variety of different sort of experiences over many, many years. What you're seeing in the market right now in response to the Israeli attack on the Iran military and potential nuclear sites is an uptick in the price of oil, but not a very significant one. And you're seeing a little bit of a move by investors to become more conservatively positioned in the face of this greater uncertainty. I'm just going to unshare my screen here for a second. And so, the reason why there hasn't been a bigger response in the oil price is because most people seem to think that this conflict is unlikely to spread beyond Iran, and therefore is unlikely to threaten the supply of oil from other parts of the Middle East. If that were to become a concern, oil prices would rise much more. So far, the view is this isn't going to spread outside of Iran in terms of crippling or in any way affecting the supply of oil to the rest of the world, which ultimately determines the price of oil. We're also not seeing a very big impact in equity prices, although there's been a little bit of what one might refer to as a risk-off trade. Let's become a little bit more conservative. We don't know exactly where this conflict is going to grow. We don't know how involved the U.S. is going to be. We don't know if there's going to be retaliatory strikes. One thing that's reassuring is that Iran doesn't have a lot of friends in the Middle East. So there don't seem to be other countries that would join the fight on Iran's side. And there is even support out of Europe for Israel to continue its campaign to try to neutralize the nuclear threat that Iran is posing to the rest of the world. So for now, the risks seem to be fairly contained, but these things can change. My colleague, the co-founder of the firm, Chuck Lieberman, put out a commentary yesterday. I'm sure Kristina can get that to you if you're interested. But we will be keeping eyes on this story. Right now, we don't see it as a big impediment to the investing environment, but be aware, it's a risk we always take into account. It is a reason why we have defense industry stocks in our balanced strategies, whether it's Lockheed Martin or Raytheon. This is a way to hedge these kinds of risks because when war breaks out, those stocks tend to go up. Other ways we're hedging the risks that I've talked about today, particularly on the tariff front, is to own companies that have and face more inelastic demand, whether that's a Philip Morris because people don't give up tobacco just because the prices go up, or whether that's a Casey in our growth strategy, which is a highway convenience store which actually sells really good pizza that people order in advance. These are less volatile companies in terms of their revenues, and therefore tend to offer investors a smoother ride. And we also build in income-oriented positions like a Kinder Morgan, for example, which pays a very high dividend because it collects fees on the transportation of oil and gas through the pipelines. And therefore, their revenues really don't depend on the price of oil very much. So again, you get a smoother ride and a high dividend yield. So a lot of steps we take here to counter these risks. We made a lot of moves, for example, at the beginning of the year in advance of the tariffs because we saw this coming. And we moved away from some of the tech companies. We just reduced our exposure because we knew they would be more volatile and put more client resources into more resilient companies, whether it was a Philip Morris, an Altria, Kinder Morgan, or a company like TJ Maxx, which tends to do well if consumer budgets get a bit tighter. So these are the ways we're active in trying to manage the exposure to risk you guys face in your portfolios. And we certainly see risk elevated at this point, primarily because of the tariff budget and a little bit of the Middle East situation. So anyway, let me stop there and y'all can, Kristina can forward some questions along.
First, I wanted to thank you very much. You do something, not only your expertise and your knowledge and your willingness to share that with us. Thank you. You also put up slides, which I'm terrible at because I find it distracting, and you've nailed it because the visual is really helpful. I do want to say to everyone that's here today, as well as all of you, we had 213 registrants, so a lot of you are going to hear this later. I want to say that ACM does put out commentary either weekly or near weekly. So if you ever want to hear what's happening in real time, what they're seeing, let me know and I will forward it to you. I intentionally try not to send you too much stuff to your inbox because you probably get enough as it is. But if this is of an interest, reach out to us, let me know, and I'll be sure that you get these. This is just an example of the resources that we have at Sequoia. And there's something Joanne didn't mention, I want to take a little further, is one of the big values we have in working with ACM is they customize for our clients. This is not put it in a box. This is not like, well, I'm not going to say any firm names out there, but like the big firms that everybody gets stuck in the same portfolio. Oh, you're all conservative, you go on that. You're all aggressive, you go here. Everything is customized because each client situation is uniquely different. And not only they customize based on the client's needs, for us here at Sequoia, we're working together on client portfolios, but they're also very tactical, as you can see, and really aware of what's happening. So it's not one of those set it and forget it strategies. I really want to bring up why we work with ACM and why they're such valuable partners to us, is that high level of customization. I would love to have them as our total portfolio managers, but I'm sure they have other people they have to take care of too. But I just want to bring that about ACM. So some questions here, and I think, I'll kind of put the question to you first, and if I'd like, I'll add some commentary to it. There was a big one that were kind of came around the manufacturing, which was with the onshoring of semiconductors in the United States. Will that sort of change the balance? Will that really change the balance of how much manufacturing we do in the United States? And what were your thoughts on that? And they didn't mention it, but this is something that's a word we don't get to use very often nowadays, which is bipartisan. Something that the Biden administration was promoting, and then the Trump administration as well is wanting. That was kind of that thing to onshore more semiconductors, especially for security issues and otherwise. So since you have a lot of experience and background in this space, you can comment on that.
Yeah, I mean, if you think back to COVID, that was, I think, the general population's first introduction to reliance on foreign supply chains, right? Remember PPE, personal protective equipment? You couldn't get, our hospital workers couldn't get masks, they couldn't get gowns. It was like we realized, oh no, this is actually a critical thing we need to have produced in the United States. Semiconductors is recognized as another critical thing that we rely on foreign manufacturing. Chips, just look around your desk right now, look around your house, look around your office. Anything that plugs in and some stuff that doesn't, like your phone or your kids' light up sneakers, all those things have chips in them, right? Your car has thousands of chips, hundreds, if not 1,000 or 1,500 or $2,000 or $3,000 worth of your car are semiconductors. So, washing machines, toasters, basically everything. And so if we can't get those chips, the economy screeches to a halt. No question about it. And so, yes, it's been a bipartisan effort for several years now to bring more semiconductor manufacturing to the US. We find ourselves in dire straits for a number of reasons. One is that one of our leading producers of high-end chips, leading manufacturers, used to be Intel. And unfortunately, Intel lost its way. They really did a poor job of continuing to develop their manufacturing recipe, if you like, how to go from bare silicon to chips, through mismanagement, effectively. And so they are no longer at the leading edge. Now, they only used to manufacture their own chips anyway. So they weren't making stuff for, cars. They were making stuff primarily for computers and servers. But there was a hope, some years ago, again, under the Biden administration, they worked with Intel to say, okay, Intel, can you please get your recipe fixed? And can you get into there was an effort by Intel to get into the business of producing chips for other companies, not just themselves. And so there was a deal struck. Hey, Intel was going to open a plant in Ohio. And that was subsidized right through the first CHIPS Act, that bipartisan act some years ago. But Intel is still having trouble. So that's one problem, is that we don't have high-end manufacturing of homegrown US companies in this country. We have other US companies that produce chips and produce them very well. Texas Instruments produces chips that go into cars and sneakers and washing machines and dishwashers and all sorts of stuff, high-end to low-end. Fantastic company. Microchip, another company out of Arizona. Fantastic company, fantastic manufacturer. Micron makes memory chips right up there in Idaho. They're expanding to upstate New York. But the biggest manufacturer of high-end chips is Taiwan Semiconductor. Okay, they're in Taiwan. We're a little worried. China's made no secret of the fact that it wants Taiwan back under its umbrella. We would not be happy to see that happen here in the US. An independent Taiwan, I think people recognize, is important for the ability of Taiwan Semiconductor to continue to sell chips to the US unimpeded by the Chinese Communist Party. So that's why, one reason why there's been so much pressure to get Taiwan Semi to build manufacturing in the US, which it is doing in Arizona. We also have a chip industry down in Austin, Texas. AMD, Advanced Micro Devices, chief competitor to Intel. It has its operations down there, but they're just design operations. It also uses Taiwan Semiconductor to manufacture chips. We have some chip manufacturing in upstate New York, Global Foundries, which used to be part of AMD, part of Advanced Micro, but they gave up on making advanced chips some years ago because it was too expensive to figure out the recipe to buy all that really expensive equipment. So yeah, we've definitely underinvested in chip manufacturing. One of the reasons is because it is so expensive. The scale economies, remember Econ 101, economies of scale, you have to build massively large manufacturing fabrication facilities in order to bring costs under control. A little chip, right, has to be driven down to 50 cents or $1. Now, NVIDIA sells chips for thousands, right? But most chips are cheap. And so the manufacturing has to be cheap. And that means you need something really, really big, which means you have to be able to serve lots of customers. Again, we don't have companies that do that here. We don't have those big, as they're called, foundries. So it's important to continue to try to incentivize the chip industry to build more manufacturing in the US so that if global political strife worsens, that we don't find ourselves without chips we need to make stuff. That is a double-edged sword. It means that, hey, the incentives for keeping the peace are really strong, right? And the incentives for finding ways to keep China from invading Taiwan are really strong because we really rely on Taiwan. But a way to give us a bit of an insurance policy is to do more in the US. So yeah, it's an important thing to do. The subsidies out of the whatever act that was back then are the most direct way to incentivize the creation of manufacturing here in the US. The threat of tariffs on semiconductors, which is being floated by the current administration, is much less effective in incentivizing manufacturing to move because the tariffs would have to be really, really high, like 100%, to overcome the cost difference. So all you would end up doing would be taxing anybody that needs to buy a chip, and you really wouldn't be effective at moving manufacturing. So economists know this. You want to move something, you want to create an incentive for something very specific, make a subsidy that's very specific to your goal. And that's going to be the least inefficient way to do it. So better to stick with subsidies than to try to do this through tariffs. So let's hope that the subsidies stay in place. It's just going to take years and years. This is not a quick fix. It takes 5 years to build a fab. And that's in a location where you already have the industrial infrastructure. So it's important, but it's going to take a long time.
I guess that's a good thing that at this point anyway, it's bipartisan, right? That it could continue on beyond a change in administration. Which
Yeah.
I imagine that would be the same with tariffs too. If they think, oh, the tariffs are specific to this administration and they might go away even in a couple of months, right? Much less 3 years, that may not be worth the expense as opposed to a subsidy, which is, hey, money in my pocket. This is, this makes sense to make this investment.
Yeah.
Next question. Is there any forecast data of when the commercial real estate market is expected to rebound?
There are lots of forecasts, certainly. Bloomberg will have a forecast. I haven't looked at it today, but there was an expectation that it was going to be this year, and then not so much. But they're holding up pretty well. So Lennar's numbers are actually pretty good in terms of the housing starts, that is, new houses that they're starting to build. They actually had pretty good data. So it sort of seems like it's flattening out a bit, which is a positive. It seems like people are getting used to the notion that mortgage rates are 7%. And, we do know, positive, that there are an awful lot of young folks entering sort of childbearing years, right? Getting married, moving out of their parents' basements that need houses. And the housing stock in the US has really not kept up with the demand. So even though mortgage rates are high, it does look like the housing market is set to rebound. It looks like it's stabilizing now. We could see a considerable improvement later this year and next year.
I would add that real estate, commercial or residential, is very location specific. So for an example, office buildings in the Bay Area, California, are struggling because so many people have gone to hybrid and remote work, and many companies have opened locations in other states. Even companies still headquartered in California have expanded in other states. Companies have expanded in Arizona, in Nevada, in Texas, in North Carolina, even in New York. So you're seeing, instead of growing this massive commercial real estate in the Bay Area, they're saying, well, let's expand because it gives our workers more opportunities, more locations to live and work in. So some markets that overbuild or built heavily can be struggling, and again, commercial or residential, whereas other markets are growing rapidly. I hadn't been to Reno since the 90s, and then 5 years ago went there for the first time as I was moving some things to Nevada. And Reno looks like downtown San Jose. I mean, looks like San Jose, sorry. It's sprawling, it's massive, it's a big tech empire. More tech companies are expanding there. East of Reno, a lot of data centers are going up, for all of the AI and everything like that. It's just stunning to see what's happened to that area. Same with Arizona. When I go down to Scottsdale about once a year and for work, and I see what's happening they have a whole like Silicon Valley growing there in that area. So the areas where people are living is changing and changed rapidly, maybe as a result of COVID. But that being said, I think real estate and what the real estate agents say, right? Location, location, location. But I think Joanne and I can agree on one thing. I don't expect to see 2% mortgage rates anytime soon. So if you bought it, keep it.
And the problem is, you're right. There is in certain areas there's excess supply of office, but it's really costly to convert office to residential.
I know, it's always like the idea, right? That's what you do. Oh, just create more housing, and it's
they've done that in a few places in New York, but it's really, really expensive.
Yeah, thank you. Now there's quite a few questions around the immigration. And the question, and I'm kind of narrowing it down more to the economic, because less of the political aspect of it is. But maybe if I combine these questions together and say, talking a little bit about the current administration's immigration policies, publicly stated, are focusing on the criminal element of immigrant, like illegal immigration or not undocumented immigration with a criminal component to it. That's the official. However, I would imagine it doesn't matter, even if that's what you're focusing on, it's going to make a lot of other people really nervous and potentially not go to the work site, etc. So combine this into the economic. How far does this have to go? If the administration expands their immigration policies further, at what point would you expect to see it have an economic effect?
That's it's already having an economic effect.
Okay, and so talk a little bit about that, because I'm trying to tie to the economic. There's a lot of questions around that. And you showed a great chart earlier about some of these sectors and we saw the native born as opposed to immigrant. And obviously that doesn't separate out people that are undocumented as opposed to people that are here legally.
Correct, does not.
Focus on the economic, what's happening with all of these new policies.
Yeah, I mean, we're already seeing it in reduced job growth. In fact, we're seeing it in the unemployment numbers because we're seeing fewer net new jobs. But we're not seeing an increase on unemployment because the number of workers in the workforce is dropping, right? And not growing as fast as net new jobs. And that's basically because the immigration numbers have come crashing down. Now that started under the Biden administration, right? If you look at the data, the immigration numbers were coming down pretty sharply under late last year, particularly. It was pretty much the whole year. You saw a decline in immigration numbers. So it's just gotten more amplified recently, right? And it is hard to separate out the legal immigrants versus illegal immigrants, right? The concern now is that with the ejection of long-term immigrants in this country, right? Illegal immigrants, right? Let's call them undocumented immigrants. They are people who currently have jobs, a lot of them, right? So whether they're working in restaurants, whether they're cleaning rooms in hotels, whether they're working on the farms, or in construction, or in manufacturing, working on, Amazon warehouses. So these are people that we're potentially going to lose from the workforce. And that's going to have a negative effect on how much we can produce, right? People are needed to produce stuff. Fewer people means less stuff. And so when you look at how that's going to affect the economy, or where it's going to affect the economy, you got to look at where they work, right? They work in the service industry, right? They work in construction, and in agriculture. So that those are the sectors that are likely to see the biggest hit in terms of their ability to produce stuff and to provide services, regardless of who's getting kicked out. Um, I don't know the data on the numbers of immigrants with criminal records versus just immigrants that are criminal because they're here undocumented. My understanding is the number with criminal records, aside from being undocumented, is pretty small. So if we just ejected them, it wouldn't have a big impact on the labor force. But that, from reports, doesn't seem to be what's happening, right? We're seeing sort of indiscriminate rounding up of immigrants at workplaces and basically being ejected. Also lawn care, house cleaning, home health care, right? The healthcare industry really relies on immigrants. I remember my mother, we had hospice care for her, and both women that we had, I don't know what their immigration status was, but they were both immigrants. So, there's a lot of service industry that relies on immigrant labor. So that's where you have to look for the impact. And it's just going to raise the cost, right? Who are you going to get to cut your lawn? Well, you know, Juan and his buddies, they're not going to show up some week, right? So who are you going to get? You get the neighborhood kid, but they're doing an internship at, Wells Fargo. They're not going to be available to cut your lawn. So there are lots of things that are going to have subtle effects, and some that are going to be substantial, like in the construction industry. So we just have to watch and see how much they actually do in terms of removing this workforce. But it could be substantial.
It's always, to me, it seems like such a simple thing to solve for. Just make sure everyone comes in legally and is screened, but make sure we have plenty of people coming in to provide opportunity. It seems to me it's almost become more of an issue of political fodder than it's become an issue that people want to solve for. And I say that as someone whose dad's an immigrant, husband's an immigrant, many of my relatives are.
Well, all of our ancestors
many
are.
pathways to come.
Unless you're an American Indian, all of our ancestors were immigrants.
Yeah,
right?
and
Just count the generations back.
Exactly.
Right?
So,
but
so
the problem is, right? A lot of people couch this in terms of, hey, but if they don't have those jobs, then Native Americans can get those jobs. The problem is our salaries are too high, right? Our wages are so high that we won't. Who are you going to get to cut the lawn? Who are you going to get to do hospice care for an elderly or a sick person?
And we have great programs, like guest worker programs and things. It's just putting it in place and not, again, making it political fodder, but rather solution-oriented people.
Yeah, a solution would be useful. Yeah.
Last question. I know we're coming up on time, but I want to ask this one because it's really fun. What is it like working with the Fed?
Well, I was a research consultant, basically. I was just working on a pretty narrow project. My husband is the Fed guy. He worked for the Federal Reserve Bank of Cleveland and Minneapolis as senior economist and vice president. And, he was actually involved in doing the economic forecasts, and he has great respect for the Fed's decision-making process. He's, utterly, completely convinced and knows, because he's been in these meetings, that there is not a political element to the Fed's decision making. That they are seeking to satisfy their dual mandate: stabilize prices, maximum employment. And it doesn't matter what any president says, doesn't matter what any congressperson says, it's completely irrelevant. Their job is hard enough without throwing politics into it. So if anybody's worried about what Jay Powell's going to do and if he's going to listen to the president, I think, from what I understand from my husband, the answer is politics is irrelevant.
Oh, there'll be many people relieved to hear that, because I constantly am expressing to people the importance of the independence of the Fed and how critical it is to our economic system. And even if you don't care about our economic system, you would definitely care about the impacts the minute our system doesn't work
Yeah, because if the Fed's not independent, then a president can say cut interest rates like they've done recently in other countries. And then you get printing money, you get runaway inflation, you get really high interest rates, and you get nobody wanting to lend to this country.
Mhm.
I think the federal debt's a problem now,
Yeah.
then it's a crisis. Then we are in real trouble, not little trouble, but like Great Depression kind of trouble.
Yes, yes, and that's I think it's critical. I feel critically important that we keep that independence. And I'd heard once I talked to someone that was very involved with the Fed, and they said that pretty much every administration has at some point tried to ask them to do something. Generally, it's closed the room. Oh, it'd be great if you do this, and they always obviously disregard it as you expressed. And they said it's just in recent years, it's the first time we've just had it more vocal, this more vocal, statement. You need to do this, you need to do that. So yes, their independence is critically important. We can manage a pretty high level of debt if we have the growth to offset it, but there certainly will be impacts. And I do believe gone long term, I mean, gone for the foreseeable future is an era of low rates. We really are going to see higher rates, and navigating that, especially in the real estate markets and other borrowing, is going to be a challenge that many Americans haven't faced for a long time. And the younger generation has never, right? And to them, 7% is like insane because they weren't around when mortgage rates were in the teens.
Right.
Yeah.
Right.
It's all perspective, right? So, but thank you very, very much for your time, Joanne. It's greatly appreciated. And we'd love to have you come back again and update us and talk more. And as I said, to everyone that's listening and everyone that comes to the recording later on, if you want to get updates from Joanne and her team on a regular basis, if you ever want to talk to them directly, especially those of you that's using this strategy, we can always arrange that. And this is, again, a way to kind of share what happens behind the scenes with Sequoia and our partners. So thank you very much, everyone, for listening. And Joanne, thank you very much for your time this afternoon.
You're back. Good to be with you, Kristina. Take care.
Okay, all right, bye.